Assalamu alaikum everyone. My name is Yasir Yamin and I welcome you all in this session. My friends, in today's class we'll be discussing September 2024 pre-mock exam officially published by ACCA for SBR. In today's session we'll be discussing question number 4 of this pre-September mock examination. This is a very good question. Primarily it covers two accounting standards, IFRS 15 and IAS 38 in particular. But there is one area in this particular question which impresses me the most, and that is about the usefulness for investors of your financial information. So all in all, I believe this is a very sound and very good question, a sort of question that you can expect in your real examination for the upcoming attempt. And so in no particular case should you ignore this particular session. Please make sure that you listen to me very carefully. So we'll start by reading this question. We'll try that we do not surpass the time limits that are allotted to us by ACCA. We'll try our best to do this within time. It is question number 4 of pre-September 2024 mock examination. It says that Fuller operates an online food ordering platform. Fuller Company basically operates an online food ordering platform. So a food ordering platform is something like Uber Eats, where people place an order for a particular restaurant. Customers want to order from a particular restaurant, but there is an intermediary platform who enables customers to put online orders, and that orders are channelized to the restaurants, right? Similar to like we have Food Panda in Pakistan, there is like Zomato in India, and things like that. So Fuller Company operates an online food ordering platform. It prepares financial statements in accordance with IFRS accounting standards. Pretty good. They say the company has a financial year end of 31st December 20x7. As I always say, please make sure that you note down the year end of the question very carefully. For accountants, two things are very important. Number one, numbers. Number two, dates. And when I say date is very important for an accountant, I mean the calendar dates, right? So 31st December 20x7, not the kind of dates you are thinking of. All right, so these dates. So it just says that the following exhibits provide information relevant to the question. You have been provided with two exhibits in particular. The first exhibit is related to the food ordering platform, and this exhibit will provide you information about an agreement between Fuller and a restaurant. So basically Fuller is an online food ordering platform. It is an intermediary between two types of parties. You channelize the transaction from buyer to seller, from customer to restaurant. So you have now done an agreement with a particular restaurant, and the examiner might be asking you how to account for that particular agreement in the books of accounts of Fuller. It also contains information about vouchers that are expected to be issued to customers. There are some vouchers, maybe discount vouchers, and these type of vouchers are supposed to be issued to the customer. Examiner is asking you how to account for these. Then moving forward, you will have your next exhibit, which is exhibit number 2. This is about technology. So this particular exhibit will provide you information about investments that have been done in technology by Fuller Company. Now, if I were you in an examination, I would not just go on reading the question as it is. The right approach is that first of all, you read the opening information which has been provided in the first window of your examination platform. You read the basic sort of information, and then you do not open the exhibits right away. Rather, you go towards that particular tab which tells you the requirement of the question. For example, in this question, if you look at the requirement is made up of two parts, part A and part B. And A part has two sub requirements, whereas B part has two sub bullets. We can see that A part cumulatively is of 13 marks, 8 plus 5 marks. And then exhibit number 2 is like 12 marks. So a total of 25 marks, 13 plus 12, 25 marks in total. For now, we are not going to focus on whatever is there in, requirement number B. You do not worry about the whole question in your first go. That's not the right approach. Although this might be your last question in your examination. So if time is less, then I would suggest that you go through both of the requirements in one go and assess that which particular requirement you really want to go for first. So sometimes it happens is then in an SBR exam, it often happens that students are left with very less time and they have to complete one whole question. Now, for example, this question is 25 marks, bifurcated into 13 marks and 12 marks, bifurcated approximately half and half. It couldn't have been 12.5 and 12.5 either way. So here a student might have to decide which part to go for. You only go for that particular part where you can score most of the marks. So in that particular scenario, if it's question number 4 and you are left with less time, you might want to read the whole requirement and then assess which part you really want to go for, where you can gain maximum marks as per the requirement. Otherwise, what I suggest is that you always go for the first requirement first, read the exhibit number 1 first, and then go for the next exhibit. So in this particular scenario, A part relates to exhibit number 1. It says using exhibit number 1 only, not exhibit number 2, and in accordance with IFRS 15 revenue from contract with customers. So when your examiner says, while you read exhibit number 1, you only focus on IFRS 15 revenue from contract with customers, the examiner has done a favor to you. Now you do not need to think left, right and center. You only need to think about IFRS 15 in particular. So this is a very, you should be grateful to your examiner and to the Almighty that your examiner comes into a pattern where a particular accounting standard and the requirement is already identified. Yeah. So you only need to have IFRS 15 in focus for now. There are 2 sub requirements. Number 1, you need to explain how Fuller should account for revenue from the sale and delivery of Go Pizza food ordered on the fullerfood.com platform in the year ended 31st December 20x7. Guys, it is very important for you to understand the importance of this word and. Whenever you see a requirement and the requirement states that explain A and B. So whenever your examiner tries to say that discuss A and B or explain A and B, analyze A and B, then what your examiner is trying to say is that your answer needs to be bifurcated into 2 particular areas. You need to talk about, in this particular case, you need to talk about how you should account for revenue from 2 things. From the sale and from the delivery of Go Pizza food. So this is how you read the requirement. So basically your examiner is asking you about 2 things. Your examiner is asking you about 2 things. How should you account for revenue from sale of Go Pizza food? And how you should do accounting from delivery of Go Pizza food. This is how you read the requirement. And this whole requirement is for 8 marks. And I hope now you better understand that the requirement is of 2 things. How you account for sale of food of Go Pizza and how you account for delivery of food of Go Pizza. Right? Then the next requirement is about, examiner asks you the accounting implications, if there are any, when the vouchers are issued to customers and when the vouchers are used by the customers. Again, the importance of and. Examiner is asking you the accounting implications, if there are any, in 2 particular scenarios. When the company provides the discount vouchers to the customers, it's often the case now. For example, if you're a loyal customer of any food ordering platform anywhere in the world, often these type of platforms provide you some discount vouchers. Yeah. So for example, you can avail discount vouchers from X date to Y date and so on and so forth. So the question is, how do you do accounting for vouchers, or what are the implications of accounting for vouchers when they are issued and when they are used? So these are two things. You need to answer, from two perspectives. What happens when the vouchers are issued and what happens when the vouchers are used by the customers. All right. Now it says in exhibit number 1, this is about Fuller. It says that Fuller operates an online food ordering platform, which is fullerfood.com. So it's an online food ordering platform where you could place your order and the restaurant gets the order and the customer is then delivered the order. Now you have signed a contract with Go Pizza. This information was already provided in the brief of the exhibit, right? It says that Go Pizza on 1st of August 20x7. Now you need to reconcile of the time, right? So this happened on 1st August 20x7, whereas your accounting year end was 31st December 20x7. And this means that the contract happened just 5 months before the year end. All right. So it says that Fuller entered into a contract with a restaurant, Go Pizza, to add its menu to the fullerfood.com selling platform. Customers make an order using the fullerfood.com website and Fuller then passes the order to Go Pizza. So as we understand, the structure of the deal is that there is a particular restaurant which you can call Go Pizza. They want more and more customers so that they can earn a profit, and then so that they can absorb their overheads. And then there is an intermediary entity in between, which is fullerfood.com, which enables the Go Pizza restaurant to grab more and more customers. And how they do it? They go and distribute Go Pizza's product through their online platform to different type of customers. Essentially, this is a particular marketing activity or a distribution activity, you can call it. So fullerfood.com distributes the product, their menu, to customers, and the customers then place an order through fullerfood.com, and that order is eventually routed to that particular restaurant. So it's fairly important for us to understand our role in this deal. We are just the intermediary. We are just connecting the buyer and seller. This is what marketplaces do. This is what online food ordering platforms do. They are just an intermediary. They connect the buyers with the sellers, and that is how they make the money. Examiner says that when the food is ready for delivery, it is collected by Fuller's delivery drivers and then delivered to customers. So examiner is saying the scenario is that when the customers place the order is channelized to the restaurant, and once the restaurant says that the food is ready, the drivers of fullerfood.com pick this food from the restaurant and then go and deliver it to the customer. So technically there are two activities involved on our end. Number one, we distribute the menu of Go Pizza to various type of customers. Essentially, this is a marketing service that we provide to the restaurant. Since we would have a large market base, we are a marketplace, we can provide good marketing services to the restaurant. And then next role of ours is that when the food is ready, we also provide delivery services on behalf of the restaurant. So for some people, you might think that there is a direct connection between fullerfood.com and the customer, and that is the only relation that is established in such a scenario. Well, that's not right. Although you are correct that fullerfood.com's delivery bikers or delivery drivers go and meet the customer. They often might be collecting the money themselves too. The customer might only be seeing the face of fullerfood.com, But essentially the contract is between the customer and the restaurant. It's essential for you to understand, and you'll get more clarity on this as you move forward into this question. It says when the food is ready for delivery, it is collected by Fuller Foods delivery drivers and delivered to the customer. The customer is then charged the price of the food ordered plus a delivery fee. So it's essential for you to understand this, how a particular transaction work. A normal transaction will be priced as, for example, if we go and determine what is going to be the transaction price in such a scenario, the transaction price is going to be the food price, and plus fullerfood.com is going to charge a delivery fee which is directly chargeable to the customer. So technically speaking, as far as food price is concerned, you are just acting as an intermediary. You are just acting as an intermediary for the restaurant. You are just channelizing sales for the restaurant. But as far as delivery fee is concerned, or delivery services are concerned, there is an independent relation, or there is a transparent, you can say, or standalone relation with the customer. Yeah, this is how the scenario works. So you basically channelize your customers towards the restaurant. When you charge the customer, you charge them the food price. So essentially this is the price which is going to go towards the restaurant. For your own self, you charge the delivery fee, and this delivery fee is only kept by fullerfood.com. So this is particularly your money. This is a transparent relationship of ours with the end customer. Examiner says that customer pays using Fuller Foods online payment system. Go Pizza sets the selling prices for the food options. So one part that you should note, that the restaurant sets this price, right? So we have no control over the price of the food. We have no control over the price of the food. All right. And then examiner says Go Pizza sets the selling price for the food option on its menu, and Fuller transfers 95% of the selling price of the food to Go Pizza when the delivery is complete. So basically, when a normal customer comes on to fullerfood.com, the flow of the transaction is as follows. They place an order on fullerfood.com. They are charged a particular transaction price, which consists of the food price and some delivery charges. As far as the food prices are concerned, 95% is sent to the restaurant. That means 5% is kept with Fuller. Yeah, common sense. And as far as the delivery fees is concerned, this is only with Fuller. So we get to keep the entire delivery fee, but we only get 5% of the food's price, which is controlled by fullerfood.com. Which is controlled by the restaurant. All right. Examiner says that some customers choose to collect the order from the restaurant themselves rather than having it delivered. So in some cases, we might not be even entitled to the delivery fee, because customers might be placing orders for pickup from directly from the restaurant. In that particular case, the transaction price is only going to consist of the food's price, 95% of which is going to be transferred to the restaurant, and 5% will be kept with Fuller. Examiner says in this case, the customer pays obviously no delivery fee. In the period from 1st August to 31st of December 20x7, the total amount charged to customers from Go Pizza was 120,000. So the entire, in the 5 months that were there, with the, where the contract was valid during the year, the total price charged to customers is $120,000, of which 21,000 relates to delivery fees. So as far as the total collection of 120,000 is concerned, 21,000 relates to delivery fees. Yeah, and therefore rest of the 99,000 would relate to the food prices. Yeah, all right. Now let's go back to the requirement once again. Examiner asks you to explain how Fuller should account for revenue from the sale of Go Pizza food. Number one, from the sale of Go Pizza food, and next, the delivery of Go Pizza food. So there are two questions within one requirement. Examiner is asking you how to account for the sale of Go Pizza food and the delivery of Go Pizza food in accordance with IFRS 15. Now guys, let's go back to the very basics of IFRS 15. You guys do remember that according to IFRS 15, revenue could only be recognized through a 5-step approach. Make sense? So the 5-step approach was, number one, that you identify a contract with a customer, right? Then it's important to identify any separate performance obligations that are there in the contract. You determine the transaction price, allocate the transaction price to separate performance obligations, and then you recognize the revenue. In this particular case, there is an identified contract, and maybe there is a written contract with the restaurant. There is an agreement by Fuller with the restaurant. So definitely the customer is identified. But what about performance obligations? In this particular case, whenever an end customer comes onto your platform, two types of responsibilities you get. Number one responsibility is to take the order of the food and send it to the restaurant, give an instruction to the restaurant that X customer has placed an order, you ready this order, and then your customer needs to get it. This is one responsibility, to channelize the food order to the restaurant. The next responsibility is, in some cases, customers ask for delivery of the food as well, in which case you have to make sure that the restaurant's food is delivered to the customer. Now we need to assess if these two items or these two promises make up separate performance obligation or not. I mean, you need to assess if the ordering of food is a separate performance obligation or not. I mean, if you think about it, IFRS 15 said that anything is a separate performance obligation if the nature of it is distinct. And what do you mean by distinct? Now, distinct is anything which the entity can provide on its own and the customer can enjoy the benefits of that item on its own. So in this particular case, the food order that we provide, the food service that we provide to the end customer, like general people, can this food be separately provided, excluding delivery? The answer is yes. I mean, we do take orders that are without delivery requirements, that are just for pickup. So that means the restaurant or us, we are able to take orders of food only, right? And the customer can enjoy the benefits of that order without the delivery. The customer can enjoy the benefits of without delivery services from fullerfood.com. So definitely the food service can be provided on its own and the benefits of it can be enjoyed on its own by the customer. So definitely this is a separate performance obligation. Likewise, as far as delivery is concerned, it is a separate performance obligation as well. Now under IFRS 15, it is imperative to identify separate performance obligations because that revenue, according to IFRS 15, revenue is only recognized when performance obligation is satisfied. And the assessment that whether the performance obligation has been satisfied or not, this assessment is based on each separate performance obligation. So now, for example, in this particular case, if you have concluded that in any particular contract, there are two performance obligations or two promises that are done by fullerfood.com. One is for ordering of food and thereon the money collected against food. And the next promise is, in some cases, you also have to provide delivery services to the end customer. If you have concluded that there are two separate performance obligation in the contract, then you also need to assess how this performance obligation is satisfied and when this is satisfied. You see, you might have understood by now that as far as the delivery is concerned, the delivery charges are separate. So you charge a separate fee for this promise, right? And yes, this is a point in time promise. So as soon as you provide the delivery service, you should be recognizing this separate fee as revenue. In this particular case, during the whole year, $21,000 was the amount that we charged from end customers for this separate delivery services. So this $21,000 straightly goes to revenue when we have provided the delivery services. Now the next question is regarding the promise of food. The orders of food is concerned. Most of you might have guessed it by now. You see, yes, you can only recognize revenue when a performance obligation regarding the food has been satisfied. But also in IFRS 15, you need to make an assessment that in any particular contract, if you are acting as an agent or a principal, I try to make you understand that how the business model of fullerfood.com really works. Technically speaking, whenever you take an order from the customer and then you pass it on to Go Pizza, essentially the substance of this transaction is that a contract is eventually being made between the restaurant and the end customer. We are just acting as an intermediary. And why do I say that? Because you see, as far as the food is concerned, all risk and rewards pertain to the restaurant. I mean, as far as the quality of the food is concerned, the quantity of the food is concerned, the preparation timeliness is concerned, the packing is concerned, the freshness is concerned, the ingredient is concerned, everything, every risk and every opportunity is with the restaurant. In this case, Go Pizza. So we are just acting as an agent on behalf of the restaurant with whom we have done a contract, and we just pull in customers, we do marketing services, we pull in customers and then provide it to the restaurant. So essentially, if you look at this transaction, you are not selling something that you own. You are not selling something that you own. The ownership of the food, the ownership of the menu of the restaurant is with the restaurant. So ultimately, the restaurant is selling something which they own directly towards the customer. We are just acting as an intermediary. Yeah. So you segregate the delivery part. As far as food is concerned, there is no additional responsibility with us other than channelizing the order towards the restaurant. So technically, we are acting as an agent in this transaction. And in accordance with IFRS 15, you might have guessed it by now. In accordance with IFRS 15, whenever a company makes a contract in the capacity of being an agent, you are not entitled to recognize the full amount as revenue. Rather, you are only entitled to recognize the part of the amounts received as a commission income for yourself. All right. So in this particular case, the scenario should be that you should be recognizing 99,005% only in your books of accounts. If I were to calculate this, let me do it. I can do it. 99,000 into 5%. This is 4950. All right, makes sense. So I hope this is pretty much understandable by every one of you. This is, pretty much clear. Yeah, I hope nothing is difficult. Yep. So now let's move on. Let's move on. Let's read the next part of this particular exhibit and then we can go towards the descriptive answer. All right. So then there are something which is written against vouchers. So vouchers, what do you understand by the name vouchers? Vouchers in this particular case would be like some discount vouchers being provided by the online food ordering platform, right? So it says that Fuller wants to provide an incentive for customer to use fullerfood.com rather than other competing online food ordering platforms. So basically what they are saying is it's a competitive environment and fullerfood.com has other competing platforms as well. And so they want to motivate their customers to more and more order to more and more order from from their platform. So they are saying that as such, Fuller is considering giving each of its registered customers. So whatever your loyal customers are, they are saying Fuller is considering giving each of its registered customers a voucher for free delivery on their next order. So we are considering that why don't we provide some voucher or maybe discount or loyalty voucher to our customers when they place their order, when they place their next order. If Fuller goes ahead with its plans, these vouchers would be emailed to customers in the next year. Now it's very important for you to understand this. Nothing is happening right now. If the vouchers are issued, these would be emailed to customers in May 20x8. Remember, your examiner asked you that what is going to be the scenario when the vouchers are issued to customers and when the vouchers are used by the customers. So the vouchers are expected to be issued next year in May 20x8. So nothing happens now in particular, okay? And then they would be valid for 1 year, they say. These would be valid for 1 year. Examiner says that Fuller would bear the cost of the vouchers and would not pass the cost to restaurants that are listed on its platform. So essentially what is happening? The happening is that if we provide vouchers to our customers, the transaction is going to look like this. You see, the normal transaction is, how do you get the transaction price determined? Under normal circumstances, the transaction price is made up of the food price plus some delivery charges. Yeah. And in case where we provide our loyal customers with a discount vouchers, when the voucher is put into the online platform, the delivery charges would be subtracted. So there are no delivery charges in that particular case. The transaction price will only consist of food prices. Make sense? Now the examiner is asking you how to account for these vouchers under 2 times. First of all, what happens when the vouchers are issued to customers? And the next part is what happens when the vouchers are utilized by the customers. You see, as far as the time where the vouchers are just issued to customers, there is no accounting implication. Yeah. But when the vouchers are utilized by the customer, there is an accounting implication. And let me give you some food for thought. Think about it. When the customer applies, we have given some discount vouchers to them, and when the customer applies that discount vouchers, the delivery charges are slashed. So let's suppose previously our transaction price was supposed to be 100 plus 10. When the discount vouchers are applied, the delivery charges become minus 10. So their delivery charges are 0 technically, and the transaction price only consists of the food price. So technically the existence, somebody might argue that the existence of discount vouchers with the customers and the use of these vouchers by the customers create a sort of variable consideration. Remember, we discussed in our normal classes that variable consideration is any consideration that varies, that is not fixed within the contract. So people can argue that these type of issuance or delivery charges can be sort of variable consideration, but I would say no. Because you need to remember that in this particular case and under the business model that we just understood, we are not acting as principal. We are not acting as principal. A variable consideration can be when there is a contract with the customer directly. But we just concluded in the earlier part that the whole scenario, presents to be a scenario in which we are just acting as an agent. Some part of the money we collect for ourselves, but most part of the money that we collect from the customers, that is essentially channelized towards the restaurant. So it's not a wholly controllable transaction for us. And in this case, this should not be a variable consideration. So, sir, what should it be? In this particular case, IFRS 15 tries to treat these type of transactions as a consideration which is payable to customers. So guys, under IFRS 15, any consideration which is payable to the customer can be treated in either of the two scenarios. Scenario number one is that if the consideration which is payable to the customer, if it results in the acquisition of, distinct nature of goods or services, then the transaction is treated as general purchases. But in case where, the consideration which is payable to the customer does not result in distinct purchase of goods or services, in that particular case, the consideration which is payable to the customer is a reduction in the transaction price. Like in this case, whenever the discount voucher is applied by the customer, it acts as a reduction in the overall transaction price. Yeah. So simply putting it, whenever the voucher is applied, the consideration which is payable to the customer, the application of the voucher will render the transaction price to equal to the food prices itself. So only 5% of that amount will be recognized as revenue. Now you might be thinking, sir, this is very simple. Why is our examiner talking about it? Because the examiner wants you to understand that this particular transaction could have been dealt in another manner as well. Now, somebody might argue that, okay, why don't we take the implication of this voucher? And we say that, normally the transaction price would have been $100 for the food, let's say, $10 for the delivery. So the transaction price is 110. We should recognize this 110 as sale. And then when the voucher is applied by the customer, why don't we recognize the cost of this voucher as a discount under our cost of sales, and thereof we net the impact? Why don't we show this transaction like that? Now IFRS 15 does not allow the application of vouchers as a discount allowed. Under IFRS 15, any impact that anything which actually reduces the consideration which is expected to be received from the customer reduces the transaction price. So the discount cannot be treated as a cost of sale. It should be a reduction in transaction price, and this is fairly clear. All right, makes sense? So this is how you would answer exhibit number 1. I have just made an answer by myself for you guys to go with it. Now, why do I provide you with my own answer? The reason is that I certainly believe that my answer is a lot different from examiner's answer. I've just not copy pasted what, how your examiner has written the answer. In my own humble opinion, I believe that the answer that I have written is more elaborative. I have touched upon various kinds of things that could have come up or should have come up within the minds of a normal student. I mean, why is this not a variable consideration? Why are vouchers not treated like something else, and so on and so forth? So I have touched upon many of the things while keeping it a brief answer. I've touched upon many of the things that your examiner's marking scheme answer does not have. That particular answer which is given on the CB practice platform, it's just cutthroat. It's just straightforward. It does not teach you what could have been the possible things that could have come into your mind. So I certainly would want you to go through my answer in particular. My answer is very precise, or rather elaborative in terms of what you could have thought in your mind, and how would you have communicated it to yourself that okay, although this particular reason like variable consideration comes into my mind, but this is not the case. Vouchers might have been treated like cost of sales, but that is not the case. You need to learn that why something is happening, but at the same time you also need to learn that why something is not happening. So my answer focuses on both of the aspects. All right, please go through these once I provide them to you. All right, then let's move on. Without any further ado, let's move on to exhibit number 2. But before we move on, let's go on to read the requirement first. So the requirement number B is that using exhibit 2 and in accordance with IS 38, your examiner is very much specific. Wow. These days, your SBR examiner often tells you that which accounting standard he is referring to. This is a blessing in disguise, I can tell you. This is a blessing in disguise. So using exhibit number 2 and in accordance with IS 38 intangible assets, examiner says explain how the technology and the data, again, the use of and. Explain how the technology and explain how the data. Two things. How the technology and how the data. So explain how the technology and the data held by Fuller should be accounted for in its financial statements. You need to do this by reading exhibit number 2. And then your examiner says discuss whether the accounting treatment of Fuller's technology and the data provides its investors with useful information. And both of these parts are cumulatively worth 10 marks for sure. Where investors' perspective is being discussed, you will get additional 2 marks for the clarity of your answer. Let's read exhibit number 2. And remember, we need to answer from 2 perspectives: how to account for the technology that is being used by Fuller.com and the data that Fuller.com basically has. So it says that during the year ended 31st December 2007, Fuller has invested in technology which collects data about food orders and deliveries from Fuller's computerized operating systems, and using algorithms transforms it into artificial intelligence, AI powered information. So we have installed a technology, we have invested in a technology. So this is hardware and software that we have invested in, predominantly an AI based software that we would have invested in, and that is why examiner refers to IS 38. Your examiner is saying what this technology does is that it collects the data from it collects the data of our orders, and using algorithm transforms it into AI based powered information. For example, there is raw data that Mr. X from California, street number X and XYZ placed an order for pizza. At the same time, let's say 2 streets ahead, another person placed out an order for pizza again. And this way you collect data and you try to analyze and you try to transform this data into information that might guide you where to target sales and how to grow your sales and how to grow your business, or what type of customers or what locality of customers prefer what type of food, something like that. So your whole business will be dependent on the quality of this data, because the analysis of this data is going to allow you to target relevant restaurants for that particular area, target relevant customers of that particular area, devise pricing mechanisms for that particular area. You might enable your application to show relevant restaurants when a customer is logged on that particular website or platform, and the location of the customer shows that particular area. Your application should be smart enough that it only presents those particular areas to the customer, which are most liked by the people who live in that relevant locality. You see, things like that. So examiner is saying, as additional data is collected and transformed, the AI continually improves its knowledge of factors such as traffic conditions at certain times of the day, and so the value of AI powered information grows exponentially. So technically speaking, you have invested in technology, and that technology is analyzing your data on a continuous basis, and then it is converting that data into AI powered information, and that information is utilized to grow your sales. It says that Fuller uses the AI powered information to provide an increasingly efficient service when connecting delivery drivers, restaurants, and customers, so resulting in higher revenues and reduced costs. So it all helps you to grow your business. And I would tell you that for any type of online platform nowadays, this kind of technology is very important, and this type of machine learning and data analysis and this sort of big data and everything, this is very important. This is very important for these type of organizations. I mean, imagine if you are being competed with another entity which also provides a food ordering delivery service. How can you make sure that you distinguish yourself from your competition? You can do that based on the data that you're collecting, based on the technology that you have spent on, and by targeting relevant customers through relevant prices and relevant restaurants and relevant reach and relevant efficient delivery services. If you do that, you can win from your competition. Otherwise, the only by making a website where customers can go place an order, I don't think it's going to be much useful. I don't think that's going to give you any competitive strength, because restaurants have their own websites as well. Yeah. So for a business like Fuller.com, this data and the analysis done on it is of very much use. It says that Fuller has put in place robust security measures to protect the raw data, algorithms, and AI powered information. So whatever data is analyzed, whatever raw data is analyzed, whatever algorithms are applied on it, whatever information that you get, all of this is with you only. So robust security measures have been implemented. So the data analysis that you have done is very specific to you. It's within your control. It's not there in the active market to be sold off. It's not there with everyone. Yeah. So something like, for example, Facebook. So Facebook catches this type of data and analyzes this data and creates a metaverse out of it, and creates a very good efficient service out of it. But all that data is not available for the public market. It's proprietary data for Facebook. Things like that. So moving forward, examiner says that Fuller paid a third party $820,000 for its data management software, and a further $1.2 million for the AI technology using algorithms. So first of all, make sure you have paid $820,000 plus $1.2 million, which is equivalent to 2020000. You have paid $2,020,000 for the technology. Yeah. If someone was to ask me how this technology should be treated, my straightforward answer should be in accordance with IAS 38. Now, according to IAS 38, an intangible asset is an identifiable non-monetary asset without any physical substance. And as far as identifiability is concerned, identifiability means that anything can be termed as an intangible asset. Any intangible thing can be termed as an IAS 38 intangible asset when, number one, it has identifiability, which means that number one, either the the item can be valued or sold separately from other assets of the entity, or the intangible asset is acquired as a result of a contractual relationship. In this particular case, definitely you have paid $2,020,000 to acquire a particular piece of technology. So this comes to you as a result of contractual relationship. So identifiability criteria is met. Definitely this particular software is non-monetary and it's an asset. It is in your control. So the technology, the data management software, the algorithms, examiner already told you, the algorithms, even the data and the information is put under robust security measures. So it is definitely under your control and it is without any physical substance. So I would definitely say that 2020 000 should be recognized as an intangible asset. If you are concerned about the subsequent measurement of this intangible asset, IAS 38 provides that any intangible asset can subsequently be measured according to the cost model or the revaluation model. So even though revaluation model is allowed under IAS 38, you need to know that a revaluation model can only be applied on a particular intangible asset when there is an active market for that particular intangible asset. For most cases, for intangible assets, there is no active market, because often the intangible assets are very much specific to the entity. So what software helps me, what algorithm helps me might not be helpful for you. Yeah. So what data helps me might not be helpful for you. Or in other cases, I would want my intangible items to be very specific and under security of me. So generally there is no active market for these type of intangible assets. And if that's the case, revaluation model cannot be applied. In that case, only cost model can be applied. And under IAS 38, it's clearly mentioned that under the absence of any other reasonable method, you will always follow straight line method. You will keep on depreciating or amortizing that particular intangible asset. For subsequent measurement, as I'm just mentioning, the cost minus accumulated depreciation minus impairment, your carrying value should be reported in your balance sheet to go. Furthermore, your examiner says that it employs skilled individuals to refine and streamline these algorithms on an ongoing basis, and pay these employees $630,000 for the year ended 31st December 2007. The value to the fuller of the improvements to the algorithm significantly exceeds the amount which is paid to staff to refine them. So basically what they are saying is that you initially paid 2020 to acquire the technology, but the technology and the AI algorithm improves once you put in data in that particular software. So the software itself has limited means, has limited value. The AI based software can only be very much fruitful for you when you put data into it and utilize it for a larger cause. And so basically you have hired engineers and experts which have been paid $630,000 during the year, and their work is directly attributing towards this technology, and that it enhances the economic benefits that arises out of this technology. Yeah. So the question is how to account for this additional 630,000 spent during the year once the technology was acquired. Now, according to IAS 38, this is a clear subsequent expenditure, and a subsequent expenditure under IAS 38 can be capitalized as far it provides you additional form of economic benefit, as well as it meets the general criteria of being an intangible asset. So you need to assess if the $630,000 spent on the skill of some workers that add value to our software is, does this cost really meet the general criteria of intangible assets under IAS 38? And my answer would be yes. Because this 630,000 is definitely identifiable, it is being separately valued. An examiner is even saying that the benefits that come out of this cost are much more than what the staff is paid for them. So basically speaking, you are getting identifiable economic benefits. The security measures are such that the entire algorithm and the improvements done on it is under your control, and definitely the improvements that come are without any physical substance. So this $630,000 should also be capitalized. Now, while I say that this additional $630,000 should be capitalized as a, for like, for example, under I-16, we read that any cost which is spent on self-constructed property is capitalized. Yeah. It's just like that. You are adding value, you are adding real value to the software by working on it. So this is not a normal software. This is an AI based software that only creates value the more you use it, right? So this $630,000 is definitely a relevant expenditure to be capitalized. However, having said that, you need to understand that it was written in the contract that AI continually improves its knowledge factors. Yeah. So this is an expert point which is specific to the modern technology that operates nowadays. Yeah. So technically speaking, since the technology is continuously improving, it might be argued that the skills that we have spent now during the year might not be relevant next year. Because as the examiner said, the technology is continuously improving. And continuous improvement means that whatever is done now is for now. Whatever is done now, we are going to reap its benefits till now. But for future, we need to get more data, and it continuously improves, and we keep on changing our decisions. We keep on changing our restaurants, our delivery, our efficiency of drivers, our prices. We keep on changing our application experience on a regular basis as more and more data comes into the algorithm and more analysis we perform. So, somebody can argue that even though we say that this $630,000 is supposed to be capitalized, but somebody can say, and I would support that fact, that this $630,000 then should be amortized within the year as well. Because whatever benefits you reap out of this data, comes, the benefits come to you right now. So you're not going to carry forward the benefits to next year really. All right. So having said that, let us just conclude how to deal with it. As far as technology is concerned, amount of 2020,000 should be capitalized and amortized over the remaining useful life. I hope this is understandable. And then the next part is that the amount of 630,000 that we spent on improvement should be capitalized, but it should be charged off within the year, so to make sure that nothing is being overstated. The AI based technology is continuously improving, and we might only be able to get the benefits out of the learnings that happens through the algorithms on a continuous basis. So somebody can argue that this $630,000 should not be carried forward to the next year, because next year new data will come in and the older one will get obsolete. And the question is how to deal with the data. No specific information is provided with regards to data. And by data, we mean the raw data that you have, and also the AI powered information that you have. The raw data comes through your orders, yeah, and based on multiple factors like the traffic, the distance, the temperature, the feedback from the customer. Based on multiple aspects, the artificial intelligence algorithm further evaluates this data and converts it into AI powered information. The question is how to account for this raw data and AI powered information. Now let me be very specific. You see, IS 38 on a current basis does not allow this type of raw data or any sort of internally generated data to be capitalized as an intangible asset. And this is merely because, there is no identifiability here. I mean, the value of the raw data that you have and the AI powered information that you develop on your own, since there is no active market for it, you are securing that data. It's only an internal data. It's very difficult to put value to this data. It's very difficult to put value to this data. And since it is very difficult to assign value to this data, independent value to this data, IAS 38 does not allow valuations, IAS 38 does not allow recognition of this data as an intangible asset, period. Right? So I have concluded the same in my answer. You can go through this once you have the answer. I have just concluded that why something, like for example, let's read about the data. The data held by Fuller should not be recognized as an intangible asset, even though the data is without any physical substance, non-monetary in nature, and being strictly controlled by Fuller. However, since its cost for data acquisition cannot be reliably measured, therefore it cannot be recognized as an intangible asset, because identifiability and putting value to this data is very judgmental and subjective. If companies are allowed to value their own raw data and their own internally developed AI based information, they could overstate their balance sheets. They could overstate their balance sheets through exaggerating the values that they self-assign on their data. Yeah. So for this very purpose, IAS 38 does not allow this data to be recognized as an intangible asset. And linking through this is the second part of the question, which asks you to discuss whether the accounting treatment of Fuller's technology and data provides its investors with useful information. You see, as far as investors of this type of a business is concerned, any such type of a business like Facebook, like Instagram, like WhatsApp, like YouTube, like fullerfood.com, any business of this sort which is operating online, this business really depends on technology, and this business really develops on the data analysis that they do. So as far as investors are concerned, investors would always want you to value their technology and data appropriately onto their balance sheets. You see, the point I'm trying to make is IAS 38 does not allow the recognition of internally developed data as an intangible asset. But does this accounting treatment provide useful information to your investors? The answer is no. The answer is a definite no. You see, as far as your investors are concerned, your investors would want to see that we are investing in a particular entity like Facebook. It's just an app in your mobile, but we are investing millions or billions of dollars into the shares of Facebook. They would want to see what is the real value, what is the real data value that they have. Yeah. So from an investor's perspective, does IAS 38 help? No. Does the rigidity of IAS 30 help? No. But do you think would it have been useful that somehow this data is capitalized into our balance sheets and somehow we can put a value to this data? Would that have helped investors in the valuation of the company? Would that have helped the investors in better analysis on the real value of the company and analyzing the share price and the dividend returns and everything? Yes. But unfortunately, IAS 38 does not allow such a recognition. Why? Because IAS 38 is of the opinion that if we allow the recognition of data as an intangible asset, the values would be so arbitrary that it can create a risk for against faithful representation, against neutrality. Yeah. So then your financial statements become too subjective, and that is why IAS 38 does not allow it. So what investors can do, investors can nowadays rely on management commentary, investors can rely on public disclosures and narrative information which is provided as additional form of information in the financial statements that are reported nowadays, and this is the only thing that investors can do. As far as the technology is concerned, the valuation of technology is now rather based on the acquisition value. We just concluded that only the acquisition value would be reported into the balance sheet. So from that sense, the continuous improvement that we are making on the technology itself, technically that part of improvement should be shown as a capitalization amount as well under your financial statements. That would help investors in valuation of the company. But you see, that does not happen. That does not happen. IAS 38, although it allowed you to recognize 630,000 additionally as a capital expenditure, but at the same time, I told you that it would be better to charge off this 630,000 within the accounting year, so that the continuous improvement impact, is truly reflected for the next year. Now, would your investors like it? Maybe not. But is it the requirement for now as per prevalent IFRS? Yes. Let us go and read the answer that I have put for you. Yeah. So I've just said that financial statements and financial information are crucial for investors as they provide a comprehensive overview of a company's financial health, performance, and future prospects. Access to accurate and transparent financial statements is essential for investors to make sound investment choices, manage their portfolios, and achieve their financial goals. Yeah. Remember that in order to make decisions about technology-driven businesses, it's imperative that you listen to me very carefully. You are not analyzing a textile company, you are not analyzing, Boeing or Airbus or a petroleum company. You are analyzing the financial statements as an investor for Facebook, Instagram, or fullerfood.com. Now, the businesses which are technology driven, investors would want information about the data these type of companies possess and also the improvements that are done on it. But recognition of such data as intangible assets, although it would be beneficial for shareholders as long as it provides a transparent and comparable basis, but IAS 38 currently does not allow this. This is because of the nature of information which makes its valuation too subjective or judgmental. So IAS 38 does not allow you to recognize internally developed data as an intangible asset right now. So investors can only rely on management commentary and other narrative reports to assess the viability and future potentials out of this data and information. I think this kind of an answer is more than enough. If you go and read the answer of your examiner, it's much descriptive. And I think even if a student writes an answer which is similar to what I have written, you would definitely get very good marks and maybe full marks for the requirement. Yeah. So guys, this is a full overview of this question. We have clearly analyzed this question in detail. I would want you to attempt this question by your own. You can get the handouts from me, the answer handout from me. You can talk to me. You can ask ask it from me, and I'll be happy to help you. All right. So please make sure that you complete this question on your own and give me the feedback. Do not forget to provide feedback. All right. Take care. Bye bye.